Last quarter, a rapidly growing, publicly traded tech company fired about 8% of its workforce.
Right, which is a pretty huge chunk of the team.
Yeah, exactly. And they actually took a $25 million restructuring hit right on the chin just to, execute those layoffs.
Which normally sends investors running for the hills.
You would think so. But Wall Street, rather than punishing the stock for what looks like a perceived slowdown, they absolutely cheered.
It is actually wild to look at the market reaction.
It is.
Yeah.
And you really have to ask why. Well, it is because the employees they let go, they weren't victims of a shrinking pipeline or lost market share.
No, not at all. They were actually replaced by the company's own internal product.
Which is the crazy part.
Yeah.
The company deployed its own artificial intelligence models to just automate internal tasks. They realized they could generate way more output and do it faster with 8% fewer humans.
It is a massive operational shift.
It really is.
Yeah.
So welcome to the deep dive. Today we are pointing the Talk Ticker's lens directly at the Q1 fiscal 2027 earnings call for a company at the absolute bleeding edge of this shift.
We're talking about SentinelOne, trading under the ticker symbol S.
Right. And, before we jump into the raw data, we should remind you, the listener, what we do here. The Talk Ticker's format is built on a very specific premise, especially for the retail investor.
Exactly. We are data forward. We translate all that dense corporate speak into actionable reality. And, we take a definitive, opinionated stance on the financial health and the strategic direction of the asset.
Because we are always looking for the signal in the noise. And the signal coming out of SentinelOne right now, it is arguably one of the most fascinating micro studies of the broader macroeconomic software environment out there.
Oh, without a doubt. But we really have to establish the current reality of this company before we hit the numbers.
Yeah, because a lot of investors are still operating on a wildly outdated thesis with these guys.
They really are. If you hear the name SentinelOne and your brain immediately goes to legacy antivirus replacement.
Oh man, like the kind of software that ran those brutal weekly scans.
Right. The stuff that quarantined harmless files and made your laptop sound like a jet engine taking off?
Yeah, if that is what you are picturing, you are entirely mispricing the asset today. SentinelOne is fundamentally an AI-powered cybersecurity platform.
And they are currently navigating what is honestly one of the most difficult transitions in public markets right now.
The pivot.
Exactly, the pivot. They are trying to move from being this growth at all costs darling of the zero interest rate era into a mature enterprise executing with just ruthless operational discipline.
And we have to give credit where it's due. That pivot is entirely driven by their relatively new chief financial officer, Sonali Parekh.
She has been instrumental. She was brought in to impose a rigorous framework on a company that historically just burned through cash to capture market share.
Like so many of them did. So the Q1 fiscal 2027 numbers we are about to unpack, they are really the ultimate litmus test of her mandate.
The big question is, can you maintain hypergrowth while aggressively expanding margins?
Because historically in enterprise software, you just get to pick one.
Right. You either grow fast and lose money, or you turn a profit and growth stalls. But SentinelOne is attempting to prove they can deliver both.
So let's get into segment one here, the headline numbers. And the top line numbers from Q1 definitely suggest the growth engine is still fully operational.
Yeah, revenue came in at $277 million for the quarter.
Which is a 21% year-over-year growth rate.
Right, exactly. But, the metric that really dictates the forward momentum of a SaaS business isn't just raw revenue.
It is net new ARR.
Right, net new annual recurring revenue. And they posted a record $44 million in net new ARR.
Which is just a massive 55% surge year over year. That dragged total ARR growth all the way up to 23%.
I would argue that 55% jump in net new ARR is the single most important data point in this entire earnings print.
Let's translate that Wall Street jargon for a second, though. For anyone who might not live and breathe SaaS metrics, why is net new ARR so much more important than just the revenue number?
Well, revenue is a lagging indicator. It basically tells you what you billed for contracts that were signed months or, even years ago.
Right.
Net new ARR, on the other hand, is the actual pulse of the current sales floor. You have to think of it like the recurring subscription revenue of a gym.
Okay, so it proves customers aren't just visiting once, They are locking in.
Exactly. It measures the absolute value of brand new recurring revenue added to the books in this specific 90-day window, net of any customer churn or downsells.
So hitting a record number there, while simultaneously pulling back on raw headcount like we mentioned in the intro, that indicates a massive spike in sales efficiency.
Huge spike. They are closing larger deals and they are doing it faster with fewer resources.
Which obviously trickles down directly to the bottom line. Earnings per share came in at 4 cents.
Which absolutely crushed expectations.
It did. It marks an 83% improvement year over year. But okay, let's look at the margins, because this is where the narrative usually gets pretty contentious.
Margin discussions always do with these hyper-growth companies.
Right. So operating margin hit 4.2%, which is a 550 basis point improvement over the same quarter last year.
And adjusted free cash flow margin landed at 6.5%, so that is a 440 basis point improvement.
Okay, I'm going to push back hard on this right out of the gate.
Go for it.
A 4.2% operating margin in a vacuum is objectively terrible. I mean, if you look at legacy software giants like Microsoft or even mature security peers like Palo Alto Networks, they are operating at massive double-digit margins.
Oh, sure. 20, 30% sometimes.
Right. So why is Wall Street giving SentinelOne a standing ovation for squeezing out 4 pennies of operating profit on the dollar?
Because you cannot value a hyper-growth, land and expand SaaS company using the exact same margin maturity curve as a multi-trillion-dollar incumbent. You just can't.
Walk me through the mechanics of that then.
Well, the 4.2% itself isn't the story. The velocity of the margin expansion is the story. In enterprise cybersecurity, customer acquisition costs are astronomical.
Because you have to court these massive global brands.
Exactly. You are paying top-tier enterprise account executives. You're flying them out to Fortune 500 headquarters. You're running these massive proof-of-concept deployments and integrating into incredibly complex IT environments.
All before they ever sign a check.
Exactly. So for years, SentinelOne ran deeply negative operating margins. They were actively choosing to lose money on year one of a contract just to get their logo on the roster.
Right, the classic land and expand model. You take the loss up front to get in the door, knowing that the gross margins on the actual software are going to be like 75 or 80% once the customer is locked in.
That is exactly the dynamic at play here. When a company like SentinelOne crosses the threshold from negative operating margin to positive, it proves that the underlying unit economics of the business actually function at scale.
Oh, I see. So that 550 basis point improvement, going from burning cash to generating a 4.2% margin, it demonstrates massive operating leverage.
Huge leverage. It means the revenue is finally growing significantly faster than their operating expenses.
So the fixed costs, things like their engineering, their data centers, the administrative overhead.
Right. All of that is now being outpaced by the sheer volume of high-margin recurring revenue just stacking on top of the platform.
Okay, that makes a lot of sense. Wall Street isn't cheering for 4.2%. They're cheering for the trajectory that gets them to 15 or 20% over the next 2 years without sacrificing top-line growth.
Precisely. It's the mathematical proof of concept that the business isn't just a bonfire for venture capital and public funds anymore.
Yeah, that makes it a much stronger asset for you to hold. But the real meat of this earnings call isn't just that they are making money, it's where that money is coming from.
Segment 2, the story behind the numbers.
Exactly. We are seeing a fundamental shift in the architecture of their revenue. For the first time in SentinelOne's entire history, non-endpoint solutions comprise nearly 50% of their total ARR.
This is a monumental shift in their identity. I mean, endpoint security, protecting the physical laptops, the servers, the mobile devices, that has always been the tip of the spear for them.
It's literally what put them on the map.
Right, but the endpoint is becoming incredibly commoditized. If you rely solely on protecting laptops, you are just constantly fighting a price war with every other vendor in the space.
Which is a race to the bottom. So pushing into cloud, data, and AI security is really the only way to survive long term.
It is.
Let's dig into the mechanics of why these non-endpoint solutions are so vital. If I am the Chief Information Security Officer, the CISO of a global bank.
You have thousands of endpoints.
right? Thousands. But my most sensitive data isn't sitting on a random teller's laptop. It's sitting in an AWS or Azure cloud environment.
Exactly. Your threat surface isn't just malware on a hard drive anymore. It's identity theft, it's cloud misconfigurations, and it's lateral movement across the network.
Because the modern enterprise architecture has essentially dissolved the traditional perimeter.
Completely. There is no longer a corporate network you can just throw a firewall around and call it a day.
Right, because employees are accessing cloud-hosted apps from, personal devices on public Wi-Fi networks in entirely different countries.
SentinelOne recognized early on that to capture the entire security budget of an enterprise, they had to move beyond the endpoint and secure the data wherever it lives and moves.
And by getting cloud and data security to nearly 50% of their ARR, they are proving to investors that they have successfully transformed from a single-point solution into a comprehensive, sticky platform.
The stickiness is the key to the valuation here.
Explain that for the listener. Why is it so much stickier?
Well, ripping out an endpoint agent is annoying, sure, but it can be done over a weekend by a good IT team.
Okay, fair.
But ripping out the entire platform that secures your AWS workloads, analyzes all your identity logs, and monitors your employee AI usage.
Oh, yeah. That requires a structural teardown of the entire IT department.
Exactly. It essentially guarantees renewal because the switching costs are just too high.
And it seems like the undisputed star of this non-endpoint growth engine right now is their AI portfolio.
Oh, absolutely.
Let's look at the specific traction there. ARR for their prompt security tool, which monitors and secures how employees interact with AI, it nearly doubled sequentially.
Not year over year, but quarter over quarter.
Right. That is insane growth. And then there was the rollout of Purple AI.
Purple AI is arguably the most significant technological leap we've seen in the security operations space in a decade.
That is a bold statement.
I'll stand by it. To
Right.
understand why it's driving so much revenue, we really have to look at the daily reality of a security operations center, the SOC.
The nerve center.
The nerve center, which frankly is currently broken at almost every major corporation.
How so?
Well, a typical SOC analyst sits in front of a dashboard that is just screaming at them with thousands of alerts a day.
And most of these are false positives, right?
Exactly. It's a developer logging in from a strange IP address or a weird script running on a legacy server. It's usually nothing.
They still have to check it.
Right. The analyst has to manually investigate each alert, cross-reference it with threat intelligence databases, write these complex search queries in specific programming languages, and then decide if it's a real threat.
The industry calls this alert fatigue.
And it leads to massive burnout and inevitably human error. Real attacks slip through because the humans are just buried under an avalanche of benign noise.
Enter Purple AI. SentinelOne cited a study by IDC, which is a major third-party research firm, and they validated a 338% return on investment for enterprise customers deploying Purple AI.
That number is wild.
It is. Let's break down the mechanics of that ROI. How does an AI agent generate a 300+% return for a security team?
By fundamentally altering the speed of investigation and response. Purple AI operates as an autonomous conversational agent layered on top of the entire security data lake.
So it's like ChatGPT for your security logs.
Essentially, yes. Instead of a human analyst spending 45 minutes writing a query in a complex syntax to find out, if a specific IP address communicated with a specific server last Tuesday.
Good basket.
Exactly. The analyst simply talks a question in natural language. Show me all anomalous network traffic originating from the finance department in the last 72 hours.
And it just knows what to do.
Purple AI instantly translates that intent into the necessary complex queries, scans petabytes of data, and returns an executive summary of the findings.
And I read it maps it to the ONTA ATT&CK framework too, right?
Right, which is the industry standard for categorizing cyber adversary behavior. So it hands the analyst a fully formed, standardized report.
So it basically compresses a 45-minute manual slog into a 4-second automated response.
Precisely. The IDC study actually calculated that queries run 70% faster and full incident investigations are completed 75% faster.
That is a massive operational shift. It closes the dwell time.
Right. The dwell time being the gap between an attacker breaching the system and the security team actually neutralizing the threat.
So when you speed up investigations by 75%, you don't need to hire 10 more SOC analysts to handle your growing data volume.
Exactly. Your existing team of 5 can do the work of 20.
So that 338% ROI is essentially the hard cost savings of not having to endlessly scale human headcount in the SOC.
That is exactly it. And that translates into massive real-world enterprise wins.
Yeah, let's talk about those wins, because CEO Tomer Weingarten was heavily highlighting their success in displacing legacy incumbents on the call.
He specifically called out a massive deal where an iconic luxury brand ripped out Splunk to replace it with SentinelOne's AI SIEM.
And SIEM stands for Security Information and Event Management. We really need to spend some time on this because taking market share from Splunk is a monumental undertaking.
It's basically unheard of. Splunk has been the undisputed king of data logging for over a decade.
So why are companies willing to endure the pain of ripping out their central nervous system to move to SentinelOne?
It all comes down to architectural limitations and cost predictability. Legacy SIEMs like Splunk, they were built in an era where data volumes were somewhat manageable,
Right.
and their pricing model reflects that. They charge based on the volume of data you ingest.
So as enterprise data has just exploded, driven by cloud adoption, remote work, IoT devices,
The cost to put all that data into Splunk has become financially ruinous for most companies.
it creates a perverse incentive.
Exactly the problem. The CSO is forced to look at their budget and say, well, we can't afford to log everything, so we are only going to log the data from our most critical servers.
And the attackers know this.
Of course they do. They specifically target the unmonitored endpoints or the obscure cloud workloads because they know the company isn't logging that data due to cost constraints.
They just hide in the blind spots. So how does SentinelOne's AI SIEM fix the physics of that problem?
It fundamentally changes the back-end architecture. SentinelOne's data platform, which was heavily built on their acquisition of Staler a few years ago, it decouples compute from storage.
Okay, so it doesn't rely on the heavy index-based architecture of those legacy SIEMs,
Right. It ingests data in a schemaless format at a fraction of the cost.
which allows the enterprise to log literally everything.
Everything. Every click, every network ping, every single authentication attempt without bankrupting their IT budget.
And once all that data is sitting in the SentinelOne data lake, they just unleash purple AI on it to find the anomalies.
Exactly. So that luxury brand didn't just buy a cheaper data locker. They bought a system that completely eliminates their blind spots and uses AI to actively hunt for threats within that massive data set.
And it isn't just corporate enterprises buying into this AI-driven security model. It's the public sector as well, which is fascinating.
Well, the government contracts are huge.
Yeah, they announced a major U.S. state government contract specifically focused on securing employee AI usage.
This highlights an entirely new threat vector that literally didn't exist 24 months ago.
Think about the risk profile of a state government. You have thousands of employees dealing with highly sensitive citizen data, health records, tax information.
And now, all those employees have access to large language models on their browsers.
The risk of data exfiltration through shadow AI is just massive.
It's terrifying from a compliance standpoint. An employee might, innocently take a spreadsheet full of sensitive citizen data and paste it into a public AI model just to ask it to format a report or summarize the findings.
Just trying to do their job faster.
Right. But the moment that data hits the public model, it is a catastrophic compliance breach.
So SentinelOne's prompt security provides runtime visibility into those AI interactions.
Exactly. The state government doesn't have to block AI entirely, which would just kill employee productivity.
They can enforce granular policies instead.
Right. They can see exactly who is using which model. They can intercept sensitive data before it leaves the network and ensure that AI adoption doesn't compromise their regulatory compliance.
It's a brilliant strategic move by SentinelOne because they are effectively monetizing the AI boom from the defensive side of the equation.
It is the ultimate pick and shovel play for the AI gold rush. Every corporation and government agency is rushing to deploy AI to get faster and more efficient. SentinelOne is selling the guardrails that allow them to do so safely.
But, the pursuit of AI efficiency isn't just something they are selling to their clients. They are aggressively applying it to themselves.
Which brings us back to the layoff.
Exactly. It leads us to the most controversial yet fascinating part of this earnings call. Amidst all the talk of record ARR and platform expansion, management announced an 8% reduction in their workforce.
Right, taking that $25 million restructuring charge in Q2 to process the severances.
But they are projecting $45 million in annualized savings. Now, typically, if a company is growing top-line revenue at 20%, and posting record new ARR, cutting 8% of the staff usually signals deep underlying problems with cash flow or a massive miss in future pipeline projections.
In a traditional macroeconomic environment, that skepticism would be entirely warranted. But if you parse the commentary from CEO Tomer Weingarten and CFO Sonali Parekh, this isn't a defensive crouch, this is an offensive restructuring.
Okay, unpack that.
They made it abundantly clear they are not cutting headcount out of desperation. I mean, they are sitting on over $800 million in cash.
Right.
They are streamlining the organization specifically because the AI tools they've deployed internally have rendered certain layers of operational bloat completely obsolete.
The phrase Weingarten used was actually pretty striking. He mentioned that internal processes that used to take months are now taking weeks or even days.
Because when you roll out frontier AI models to your own software engineering teams, your marketing departments, your customer success organizations, the output per employee radically shifts.
So if an AI coding assistant helps an engineer write, test, and deploy code 40% faster, you simply do not need to hire the next tier of junior developers.
Exactly. Or if AI agents can automatically triage and resolve level 1 customer support tickets, you don't need a massive call center footprint anymore.
And that $45 million in annualized savings isn't just dropping to the bottom line to make the quarter look good, right?
Oh, they are aggressively reallocating that capital. They're taking the money saved from human operational bloat and redirecting it into high-conviction R&D vectors.
Like further development of Purple AI.
Right, and expanding their data lake capabilities and pushing deeper into cloud security. It is a highly intentional capital allocation strategy.
They are shifting away from a labor-heavy operating model to a compute-heavy operating model.
That's the perfect way to phrase it.
But let's stress test this strategy for a minute. A significant portion of this 8% cut is hitting the sales and go-to-market organization.
Yes, it is.
If you are a SaaS company, your revenue growth is mathematically tied to the number of quota-carrying sales reps you have knocking on doors and taking clients to dinner.
Historically, yes.
Right. So if you cut your sales force, how do you possibly maintain a 20% top-line growth mandate? You can't just replace enterprise relationship building with a chatbot.
Well, you don't replace the relationship building with the chatbot. You replace the entire distribution motion by leveraging structural force multipliers.
Okay, what does that mean in plain English?
It means SentinelOne is fundamentally evolving how they sell software. They are moving away from the brute force method of hiring hundreds of direct sales reps and instead leaning heavily into massive channel partnerships and cloud marketplaces.
Okay. The LevelBlue partnership they highlighted on the call is the perfect example of this, isn't it?
It is. LevelBlue is one of the world's largest managed security service providers, or MSSPs.
So an MSSP essentially acts as the outsourced IT and security department for thousands of mid-market and enterprise companies who just don't have the internal resources to run their own SOC.
Exactly. By signing a massive partnership with LevelBlue, SentinelOne doesn't need to send their own sales rep to pitch every single one of those end customers.
LevelBlue just bakes SentinelOne's platform into their standard offering and sells it for them.
Precisely. SentinelOne gets access to a massive global installed customer base with zero customer acquisition cost on the direct sales side.
It's a pure leverage play. You let the aggregator do the heavy lifting of distribution.
And they are doing the exact same thing with the major cloud providers. They announced a deep integration into AWS Security Hub.
I would argue the AWS integration is actually even more powerful than the MSSP route.
Oh, easily. Historically, buying enterprise security software involved a brutal procurement cycle.
You had to run a 60-day proof of concept, get budget approval from the CFO,
negotiate a complex multi-year contract through legal, and then spend months actually deploying the software.
But now, with the AWS Security Hub integration, an enterprise customer who is already hosting their infrastructure on Amazon can simply log into their AWS console.
Click a button to turn on SentinelOne's AI-powered runtime security.
And the billing is just automatically routed through their existing AWS account.
Exactly. No new contracts, no legal review, no direct sales rep involved, just a frictionless pay-as-you-go deployment model natively embedded in the cloud infrastructure they already use.
So when you have distribution channels like LevelBlue and AWS doing the selling for you, you simply do not need the same massive bloated direct sales organization that you required 3 years ago.
Which is why the 8% workforce reduction makes sense. It's a reflection of this changing go-to-market strategy. They are trimming the legacy sales structure because the platform is increasingly being bought through these highly efficient automated channels rather than being sold through traditional cold calling.
That makes total sense. Which brings us to segment 3, the forward-looking metrics, management guidance.
Always the most important part for the stock price.
Always. We've seen the Q1 results, and we understand the structural shifts driving them. Now, we have to look at what Sonali Parekh and the executive team committed to for the rest of fiscal 2027 and how the market is digesting those numbers.
Let's start with the immediate horizon, Q2.
They guided revenue to a range of $289 million to $291 million.
If they hit the midpoint of that range, it represents roughly a 20% year-over-year growth rate.
Operating income is guided to $23 million to $25 million, which pegs the operating margin at a healthy 8%.
And EPS is projected to land between 6 and 8 cents.
So the Q2 guidance is solid, but the full year fiscal 27 guidance is where the narrative really crystallizes, I think.
I agree. They reiterated their full year revenue guidance of $1.195 billion to $1.205 billion.
That locks in their trajectory as a 20% growth company at a massive scale. I mean, surpassing $1 billion in annual revenue is a rare milestone in enterprise software.
It puts them an elite company. But the absolute headline of the guidance was the massive revision upward on profitability.
Yeah, they raised their full year operating income guidance to $115 million to $125 million.
That firmly establishes a 10% operating margin target for the entire year.
Which is a staggering 650 basis point increase over their fiscal 26 performance.
Think about the mechanics of a 650 basis point margin expansion on $1 billion revenue base.
It's huge.
They are extracting tens of millions of dollars of pure operating profit out of the existing business model simply through the AI efficiencies and the strategic restructuring we just discussed.
They are proving that the leverage in their model is not theoretical. It is actively printing cash.
But here is the piece of the guidance that really requires some scrutiny.
The RPO.
Yes. Alongside the revenue and margin numbers, they reported their RPO remaining performance obligations.
And RPO hit a record $1.5 billion, which is a 30% increase year over year.
Let's make sure the mechanics of RPO are crystal clear for you listening, because it is the most critical leading indicator of a SaaS company's future health.
RPO is basically the total value of all the multi-year contracts a company had signed, but has not yet recognized as revenue because the service hasn't been fully delivered yet.
Right. To use a metaphor, if ARR is the base salary a professional athlete is getting paid in the current season,
RPO is the total value of the 5-year guaranteed contract they just signed.
That is a perfect framework. The money hasn't hit the bank account yet, but it is legally locked in and guaranteed to be paid out over the life of the deal.
So when a customer signs a 3-year contract for SentinelOne's platform, only the first year hits the current ARR.
Right, and the remaining 2 years sit in the RPO bucket.
Therefore, RPO represents a massive backlog of guaranteed future revenues sitting on the balance sheet.
And when you see RPO growing at 30%, which is significantly faster than their actual recognized revenue growth of 21%, it means their sales pipeline is accelerating.
The total volume of massive multi-year enterprise commitments is expanding rapidly. It provides immense visibility and predictability for their future cash flows.
Which is why the market loves it.
But that brings me to my core point of friction with this guidance.
Let's hear it.
I'm looking at a company with a record $1.5 billion in RPO, growing at 30%. They are seeing massive adoption of their non-endpoint platform. They just raised their profit guidance substantially based on internal efficiencies.
Yeah.
Yet, they only maintained their full-year revenue guidance at 20%. They didn't raise the top-line target a single inch.
It's true.
If the pipeline is that stuffed, if the RPO is expanding that fast, and if the platform is displacing legacy giants like Splunk, why aren't they raising the revenue guide? Are they playing it way too safe?
They are playing it exceptionally safe, yes, but that is a deliberate, calculated decision by Sonali Parekh.
Okay, why?
You have to evaluate the guidance not just based on internal momentum, but on the external macroeconomic reality of enterprise software procurement in 2026.
Fair point.
Yes, the pipeline is massive, and yes, the RPO shows the demand is there. But the mechanics of actually closing a 7-figure enterprise software deal right now are brutal.
Because the cost of capital is still a major headwind for these massive corporations.
Exactly. Interest rates are not back at zero. Inflationary pressures on corporate budgets are real. In this environment, a Fortune 500 CIO cannot simply sign a $1 million purchase order for a new cybersecurity platform on their own authority.
That deal has to go through the CFO.
It has to go through a procurement committee. It often has to go to the board of directors for final approval.
The scrutiny on software spend is just at an all-time high right now.
It is unprecedented. And what that scrutiny causes is deal slippage.
Right.
A massive contract that the SentinelOne sales team was 90% sure would close in Q2 gets delayed because the client CFO wants one more meeting to review the ROI metrics.
The deal isn't lost. I mean, cybersecurity is an existential necessity. They have to buy the platform eventually, but the timing slips from Q2 to Q3.
Exactly. So Parekh is building a massive margin of safety into her revenue guidance to account for that macro friction.
She refuses to put the company in a position where a few delayed enterprise deals cause them to miss their quarterly numbers.
Because in public markets, maintaining guidance and quietly over-delivering is infinitely better than raising guidance by 10 million and missing it by 1 million.
Oh, absolutely. It's the classic expectation management game, and she is playing it flawlessly. She is establishing a floor that she knows the company can clear, even if the macro environment worsens.
Which perfectly tees up our final analysis, segment 4, the bottom line.
Right. We have dissected the mechanics of the quarter, the technology shift, the internal restructuring, and the conservative guidance. It is time for the talk ticker's bottom line.
For you, the retail investor staring at the ticker symbol S, analyzing this asset for your own portfolio, what is the ultimate verdict?
Well, the verdict from us is strongly bullish.
Strongly bullish.
And the foundation of that bullish stance is built on their trajectory toward a critical software valuation metric, the Rule of 40.
The Rule of 40 is the ultimate crucible for SaaS companies.
Let's explain it real quick. It is a very simple mathematical formula. You take the company's revenue growth rate and add its profit margin.
If the combined number equals 40 or more, you have an elite, top-tier software asset that is perfectly balancing growth and profitability.
So if you are growing top-line revenue at 40%, the market will completely forgive a 0% profit margin.
Right. But if your growth slows down to 10%, you better be generating a 30% profit margin to compensate.
Currently, based on their full-year guidance, SentinelOne is projecting 20% revenue growth and a 10% operating margin.
That puts them at a rule of 30.
Right, 20 plus 10. On the surface, that might seem like a miss.
It does, but the market isn't valuing them on the snapshot of today. It is valuing the derivative of the trend.
Explain that.
They just expanded their operating margins by over 500 basis points in a single quarter, and they are projecting a 650 basis point improvement for the full year.
The velocity of the margin expansion is just a straight vertical line.
Exactly. If they maintain a 20% growth rate through their AWS and MSSP distribution channels, and they push their margins from 10% to 15% and then 20% through continued AI operational efficiencies,
They cross the Rule of 40 threshold within the next 24 months.
the underlying physics of their business model are rapidly accelerating toward that elite status.
But let's look at the downside protection, because the single biggest risk when investing in mid-cap, high-growth technology companies is always the balance sheet.
Always. Companies that burn cash to grow eventually run into a wall.
They either have to go back to the public markets and issue more shares, which massively dilutes your equity as an investor, or they have to take on debt.
And in a high interest rate environment, taking on corporate debt is incredibly toxic. It destroys cash flow.
This is where SentinelOne presents a highly de-risked profile for you, the retail investor. They are currently sitting on $812 million in cash equivalents, and short-term investments.
And more importantly, they carry zero debt.
Zero debt.
Zero debt on the balance sheet. In an environment where the cost of capital is a massive constraint for their competitors, SentinelOne has total financial autonomy.
They do not have to worry about servicing crippling interest payments.
They have nearly $1 billion in dry powder to aggressively fund their own R&D, push the boundaries of purple AI, or even pursue strategic acquisitions if a smaller, innovative startup presents an attractive integration opportunity.
And the final piece of the bullish thesis is the customer unit economics, specifically the net retention rate,
right,
or NRR.
We talked about how the platform is expanding beyond the endpoint into cloud and data. The proof that this strategy is working is in the enterprise spending metrics.
Customers who spend over $100,000 annually with SentinelOne grew by 17% year over year.
But the more vital number is that the NRR for those large customers is expanding above 110%.
Net retention rate is the ultimate measure of product stickiness, right?
It really is. An NRR of over 110% means that if SentinelOne completely shut down their sales and marketing department tomorrow and didn't sign a single new logo for the entire year,
the revenue from their existing enterprise base would still grow by over 10%.
Exactly. Why? Because those massive Fortune 500 clients are so heavily reliant on the platform that they are constantly buying more modules, securing more cloud workloads, and upgrading to new features like Purple AI.
Once SentinelOne lands inside an enterprise infrastructure, they spread rapidly, and the revenue compounds automatically.
So if we consolidate the entire narrative, you have a visionary, founder-led tech company in Tomer Weingarten that isn't just slapping the word AI onto a pitch deck.
No, they're generating hundreds of millions of dollars in highly sticky, recurring revenue by deploying autonomous behavioral AI to solve the most complex security challenges in the world.
And you pair that visionary product leadership with a highly disciplined CFO in Sonali Parekh, who is ruthlessly driving the company toward GAAP profitability, sitting on a fortress balance sheet with zero debt.
And they are doing all of this while navigating the extinction of legacy antivirus.
The era of protecting a network with signatures and known hashes is fundamentally over. Threat actors are utilizing generative AI to write novel, polymorphic malware that has literally never been seen before.
You cannot defend against a machine-speed AI attack with human analysts and legacy data loggers.
The only viable defense is autonomous behavioral protection executing directly at the runtime layer. SentinelOne is the architectural foundation for that new paradigm, making their technology an absolute, non-negotiable necessity for the modern enterprise.
The invisible, autonomous fortress of the future. Let's bring this deep dive in for a landing, with the core, actionable takeaways you need to have logged from this Q1 fiscal 2027 print.
The big three.
Number one, the growth engine is highly efficient, evidenced by a massive 55% surge in net new ARR, hitting a record $44 million for the quarter.
Number two, the 8% structural workforce reduction is not a sign of weakness. It is a strategic capitalization on their own internal AI efficiencies, rapidly accelerating their path to a 10% full-year operating margin.
And number three, the financial foundation is bulletproof, with an $812 million cash position and absolutely zero debt, providing total operational autonomy in a constrained macro environment.
I want to leave you with a macro implication that extends far beyond just the valuation of this specific ticker symbol. It's a concept that wasn't really debated by the Wall Street analysts on the call, but it is the most profound secondary consequence of what SentinelOne just executed.
This is the exact kind of signal we look for. What is it?
Well, consider the mechanics of the 8% layoff we talked about. SentinelOne, a company filled with elite software engineers and data scientists, successfully deployed AI to automate their own internal workflows, which allowed them to trim 8% of their human operational bloat while actually accelerating their output. They proved that AI can safely and effectively replace specific layers of corporate labor.
And they did it successfully.
Exactly. Now, extrapolate that outward. If a lean, hyper-efficient technology company can find 8% of its workforce to cut through AI automation, what is going to happen when SentinelOne's massive enterprise clients, the century-old global banks, the legacy manufacturers, the bloated Fortune 500 dinosaurs, what happens when they realize they can apply those exact same AI efficiencies to their own organizations?
Oh, wow.
We are on the precipice of a massive AI-driven corporate restructuring cycle. These non-tech enterprises are going to use AI to trim 15, 20, maybe even 30% of their manual operational headcount over the next 3 to 5 years.
That is a staggering thought.
And as they do that, as human workers are replaced by autonomous AI agents executing tasks in the cloud, securing those AI agents becomes the single most critical existential priority for the enterprise.
The entire attack surface shifts.
Right. It shifts from humans clicking on phishing emails to AI agents being manipulated by malicious prompts. SentinelOne is actively building the specific security layer required to protect that exact, highly automated future.
It fundamentally reshapes how we view their total addressable market. They aren't just securing the enterprise as it exists today, they are building the immune system for the AI-automated enterprise of tomorrow.
That is the definitive signal in the noise.
Thank you for joining us for this Talk Tickers Deep Dive. Keep running the math, keep questioning the consensus, and we will see you on the next Deep Dive.